Is your money safe? The fall of Lehman Brothers.
A new day and a new reality is dawning on Wall Street.
Make no mistake, the Federal Reserve is bailing out Bear Stearns.
That is a whopping loss of $3.5 billion in market value today alone.
The financial crisis of 2008 sent the world into a tailspin.
I never thought it would come to this. It's just a tragedy.
Shocked, really shocked.
Its sheer scale threatened to bring down not just the big banks, but the entire global economy.
The lack of capital has resulted in the elimination of Bear Stearns, the bankruptcy of Lehman Brothers, and the transfer of Merrill Lynch, and a complete rethinking of how the American financial system functions. This is a day that will be remembered forever, September 14th, 2008.
Governments around the world, including the UK, have thrown huge amounts of money at the problem, in some cases taking over the banks completely. So what now? How long will governments be stuck with equity stakes and debt guarantees? And what's to stop this from happening all over again?
In this program, we search for clues to our financial future by examining the ghosts of crises past.
The big lesson from Japan is that it's much, much better to act too soon than too late, to do too much than too little.
Tim Geithner and Larry Summers used to say that we're too late. But are they quick enough now?
Every banking crisis is solved sooner or later. It's a question of how fast and to what cost.
Japan and Sweden each battled their own banking crisis in the 1990s. One came out of it swiftly, the other faced a lost decade. The question is, which one are we? Japan in the 1980s was the envy of the world. Iconic brands had exploded onto the international scene, from high-tech to high-speed. With an economy growing at an average rate of 4% a year, the country was awash with cash, and the Japanese were spending.
First half of the 80s was probably Japan's golden age, because everybody thought Japan's miracle, and everybody thought the rest of the world must learn from Japanese management.
But the golden age was in part an illusion, a paper tiger, and it came to an abrupt end. When the bubble catastrophically burst in 1990, the island nation plunged deep into an economic crisis.
They had many insolvent banks, banks that had loans that if they were marked to market, would have made the banks insolvent.
There were fundamental flaws in the economy. Despite the flashy success of international brands, Japanese banks had in fact for years been supporting many weak and inefficient domestic companies.
So what happened was we had zombie borrowers that were kept alive by the banks that just kept lending them more money to repay their debt.
By throwing good money after bad, the grim reality wasn't being resolved, merely delayed. But Japan kept on building and buying.
Dealing with it would have recognized the scale of the wealth losses that had been caused by the collapsing of the property and the stock market bubble, and they just weren't prepared to do that.
They took a really bad situation and made it worse and worse and worse through years and years of denial and dithering and cover-up.
Rather than facing up to the losses, instead problems were disguised. The government was accused of encouraging banks to cook the books and use murky accounting practices to bolster their numbers.
They hid many of the bad assets by sending them to subsidiaries at a book price so that they don't have to incur losses, book losses. But actually the losses keep increasing the huge amount.
The cumulative losses, however, couldn't be concealed forever. The government needed to step in. But getting political consensus on just how to act proved difficult.
Ministry of Finance has insisted that public money has to be infused very quickly. But because of the resistance, it was delayed, and delayed.
Public money was drip-fed into the financial system, but it wasn't enough to allow for much-needed write-downs. Meanwhile, it remained business as usual at the banks, with nothing compelling them to change their ways. The crisis reached its peak in 1997 and 98, when several banks collapsed and had to be rescued by the government.
American government was always saying that, well, let bad banks go down. But if it constitutes a systemic risk, we shouldn't let them go down. We should infuse the public money to support the banking system. And the Americans eventually recognized that when their banking system went down. so it was a very difficult period. Yeah.
With zombie banks lending to zombie borrowers, clearly the government needed to target the root of the problem and not just allow the banks to continue their poor lending practices. It needed to force them to write off their bad debt.
That finally happened in 2003 with a new push for transparency.
What the Japanese authorities did in 2003 was to conduct a round of special inspections at banks and finally come up with a credible figure for the bank losses. And this changed the situation dramatically by removing this uncertainty, and market liquidity flooded back.
Outsiders were brought in, like Masamoto Yoshiro, who had been working in the United States for Exxon. Under his leadership, the failed long-term credit bank was reborn as Shinsei Bank, now one of Japan's most efficient and profitable financial institutions.
I found close to 30% of the assets were really bad, non-performing loans. So I either collect it or help them to restructure so that they can regain health.
It had taken almost an entire decade for Japan to reach this point, and the delay cost the country dearly.
The consequence is what in Japan they call the lost decade, where basically the economy barely grew for almost that entire period.
Given this poor outcome, it's not surprising that many hold the case of Japan as an example of what not to do when facing a financial crisis. To find a more positive model, we'd have to travel to the other side of the world. Sweden's capital city, Stockholm, is a far cry from frenetic Tokyo. But its slow pace and relaxed lifestyle didn't make it immune to its own banking crisis. In the early 1990s, soon after Japan, Sweden too experienced a massive meltdown. Sweden's disaster, like Japan's, arose after the bursting of an asset bubble. Speculative lending by its banks had ballooned following financial deregulation a few years earlier.
The loan ceilings were gone, so they were free to do whatever they wanted, and that meant a lot of lending to commercial real estate.
Prices of houses, of stocks and shares, everything increased in Stockholm and in Sweden. And we had a real boom. We were lucky, we thought, but the boom bust.
For a year or so, the magnitude of the crisis was not clear. Then, in the autumn of 1992, it became painfully obvious to those in charge.
We were convinced that we were very, very close to an extremely serious situation where the whole system was about to blow up.
Senior officials in the Ministry of Finance concluded they had to act or the system would fail. The solution was swift and drastic, a blanket guarantee.
We guaranteed all creditors and depositors
of course not shareholders in the banks, and all banks were eligible to apply for support.
So it was really a very simple, forceful way of buying enough time so that we could start dealing with the real problems in the individual banks.
The speed of the decision was helped by Sweden's consensus culture. The finance ministry, the central bank, and all political parties were in agreement about what to do.
Both the government and the opposition had been involved in creating the crisis, so there was no blame game. Instead, we could say look forward and fix it.
4 of Sweden's 6 main banks received support. 2 of these were nationalised, including Nordbank, already part-owned by the government. But it seems even in a small, open economy like Sweden, nationalisation is a dirty word.
I don't like the word nationalization. I prefer owner of last resort. Owner of last resort does not mean that you end up owning banks with the intention of owning them forever. You clean up the banks. Once you have cleaned up the banks, sorted out the mess, then you privatize them, then you sell them back to the market as quickly as possible.
Stefan Ingves became the man at the helm of the cleanup. He led the bank support authority set up to oversee the newly nationalised banks. Since the government either owned or was heavily invested in most of Sweden's banks, they could make some tough demands.
The banks that we ended up taking over, the management was changed, the boards were changed.
We were very hard on that, and we demanded compensation from the boards of Gota Bank and Nordbanken.
If you only give money to the banks and say, here it is, go and improve yourself, then people will learn that you can sort of get away with it.
Hans Dahlborg was brought in to run Nordbank. His immediate task? To strip down the bank to its bare bones.
One of the politicians said the ribs should be seen on the bank, which actually meant that we had to cut costs by between 20 and 25% in order to survive.
Transparency was paramount. Banks were ordered to open their books to reveal the true nature of the losses. Assets were then separated into good and bad.
As long as you keep the bad assets on the balance sheets of the banks, you don't have functioning banks. You need people with a different focus, and you need people with a different mindset to deal with the bad assets.
It wasn't long before Nordbank, which has since become Nordea, was on the road to recovery.
We posted a profit in 93, and in 95, 96 we started the privatization again by selling out on a big roadshow a chunk of the stocks, and then we made a directed buyback to the government to reduce their share of the bank.
This partial reprivatization, together with the gradual sell-off of the toxic loans, meant the money the government spent bailing out its banks was paid back almost entirely and more quickly than expected. But the true cost to the Swedish economy runs much deeper.
We ended up in the early 90s with negative growth for 3 years. And that was the first time since the 1930s that that had happened to us. And it is almost impossible to recuperate that lack of growth afterwards, later on. And this is why a banking crisis is so expensive, but expensive in a real economy.
Both Sweden and Japan offer valuable lessons in how to confront a financial crisis. Can either serve as a crystal ball into our future? We're digging up the ghosts of crises past. and taking a fresh look at the experiences of Sweden and Japan in the 1990s, in the hopes they may shed light on how and when the current banking crisis may be resolved. Yet it would be unwise to draw too close a comparison, given that both countries were dealing with local problems demanding local solutions.
The sheer scale of the global crisis compared to Sweden or Japan means there's a limit to what we can learn from the past. But what seems clear is the decisiveness of Sweden beats the dithering of Japan. So what about now? Are governments dithering, or have they laid out a clear path to an exit?
On both sides of the Atlantic, the authorities were pretty dithering in their response to the crisis. Now, given what had happened in both Scandinavia and Japan, I do find that absolutely staggering. You'd think that there would have been some sort of forethought about this. I think the evidence is that in fact there was none.
At the epicenter of the implosion, New York City. The scope and severity of the financial system failure took many on Wall Street by surprise. Bank after bank after bank felt the fallout. Washington too was caught unprepared, but as with Sweden, once the breakdown became apparent, policymakers woke up.
From NBC News World Headquarters in New York.
Under our proposal, the federal government would put up to $700 billion taxpayer dollars on the line to purchase troubled assets that are clogging the financial system.
Members of Congress tonight are trying to find a way to make a $700 billion mortgage bailout plan go down a little easier.
You could argue whether it was done well or not, but certainly there was big action and quick action.
Without it, life would have been much harder for the policymakers, much more difficult for the financial system, and there would have been more negative impacts on the rest of the real economy.
So US government has learned. They move very swiftly, where Japan took many years.
Governments in the US and other countries may have reacted with more speed than Japan, but they weren't as forthright as Sweden.
Our first responses were kind of stumbling. Both the US and the UK have been hurt by a fair degree of indecisiveness about what the policies are.
If you read the 1,100-page stimulus bill before the vote.
Gentleman's time has expired. Gentleman from Massachusetts is recognized.
What you have just heard is a denunciation.
Would you yield?
Yes.
Mr. Chairman, truly all I ask is transparency.
The gentlelady from North Carolina.
This bill really is redundant, and if it isn't political theater, would the gentleman yield?
Fundamental differences of opinion on how to solve the crisis have triggered heated political debates.
Mr. Chairman, I ask you to instruct the gentleman.
One major problem in the Japanese case was the political resistance. Same thing is happening in the United States. Congress is a major obstacle.
With all the tensions between the Congress, between the Federal Reserve and the White House, and the American way of muddling through, it's such a difference.
And what about facing up to the size and spread of the trouble? Are banks today being as transparent as Sweden about the toxic assets they actually own? Or are they obscuring them with smokescreen accounting, like Japan?
In the autumn of 2007, the Fed could have and should have knocked heads together in the banks and demanded of them to come with credible information as to the makeup of the asset-backed securities and the derivatives. On this kind of credible information, we could have built more reasonable default scenarios. Now, this is one actually of the main lessons from the Japanese experience, and this wasn't done.
Though there have been an estimated $4 trillion of write-offs, mostly by the big international banks, many say there are more to come.
There is an inherent bias towards not writing down bad debts, which has been really magnified in this particular recession by changes in accounting rules. So they've actually got less assets than they're pretending they have at the moment.
The government lacked transparency on what was going on
in many of these firms, and indeed still does. We are seeing now trillions of dollars being expended by the US, for example, but we are not seeing any real understanding of the magnitude of the problems, nor the potential magnitude.
But not every country has allowed such ambiguity to continue. Switzerland has ordered its troubled banks like UBS to isolate their toxic assets and make a full disclosure.
They were forced to be very, very open about exactly what happened, exactly why they made the mistakes they had made, and what they had on their books. That's sort of more like the Swedish model than what we've seen in the US and the UK.
Government spending to bail out banks and boost the economy has been unprecedented, almost $11 trillion worldwide. Yet despite this staggering amount, some argue the recapitalization has been insufficient to clean up the mess. Even worse, like Japan, governments are failing to make the necessary demands on banks to safeguard against a future financial washout.
First of all, not enough capital in the banking system, so the losses have not been fully replaced and replenished. And there's been undue deference to the insiders in these banks. So instead of changing the management of banks that had failed, we've kept on largely the same people, we've kept the same sort of structures, we've kept the same sort of incentive schemes. We've changed nothing about the system that brought us to this point. And this is really asking for trouble down the road.
Good morning, veterans! Good morning, Metro!
Taxpayers funding the bailouts may in fact have the worst of both worlds. Their money has been used to cover the losses, but since governments don't completely own the bank's assets, the public won't get the full reward from a recovery.
Oh, I think we should just have bitten the bullet, nationalise the banks outright, and in the process, of course, the taxpayer would have stood to gain from the upside as well as taking on the downside.
And it's not a small amount of downside, it's huge. We've doubled our national debt as a result of this crisis. For what? What did we get out of that? Nothing. What did the bankers get out of that? Quite a bit.
And that's the problem with a system where the government ends up footing the bill. It's heads I win, tails you lose. Profits are privatized, losses are socialized. So, where is the incentive then to stop taking risks?
Bailing out the banks creates a distortion that economists call moral hazard. By insuring people or institutions, you encourage risky behavior.
So they are apt to take new risks in the future. So that's one of the reasons I think that you should be very hard on banks.
Being hard on banks likely means governments will pass tough new regulations to make it more expensive for banks to carry on recklessly pursuing speculative profits.
First of all, we are going to contain derivatives. You won't have the Wild West. Secondly, we're going to have a strong regulatory authority, and they will say to any entity, you cannot get way more indebted than you could possibly pay off.
Capital adequacy will go up in one form or the other. It's also possible that we need a leverage ratio such that regardless of what capital adequacy happens to be, it makes it impossible to sort of expand the total balance sheet beyond a certain point.
The difficulty I have with all of the approaches we've seen right now is they all seem to be dealing with last year's crisis. And the one thing we can be sure of is that the next crisis is not likely to look anything like the last crisis. So we need broader authority, but also less invasive at the outset authority that allows regulators to meet changing conditions with a full arsenal of weapons at their disposal.
While policymakers around the world debate how to fix their broken banks, it still remains uncertain how long governments will be stuck with equity stakes and debt guarantees. The global banking system has proved to be so intertwined and complex that perhaps, unlike Japan and Sweden, this time there is no clear exit.
It may well be that we've reached a world where banks can't go bust anymore, and the public are guaranteeing the safety of large banks forever. That's a really uncomfortable position because somebody will abuse it. If you've got no downside, why wouldn't you? Sooner or later it will happen.
The banks may repay their bailout money and eventually buy back government-held stakes. But the cost of the crisis will not end there. Just as with Sweden and Japan, there will be a bigger price to pay by the wider economy. And with national debts rising to $10 trillion in the US and $2.25 trillion in the UK, this price will be paid by generations yet to be born.